Welcome back to Dollar Chronicles. Make sure to like this explainer and subscribe so you never miss out. Today we're diving into a massive global mystery. Imagine waking up to find that the United States government had quietly orchestrated a massive financial strike across the globe. Not to fund a war, not to bail out a domestic bank, but to secretly rescue the currency of a foreign nation thousands of miles away. It sounds exactly like the plot of a financial thriller, but it just happened in real life. When news of this totally unprecedented intervention broke, the public was quickly handed a very simple, surface-level explanation. President Donald Trump addressed the nation and described the move as a simple signal of friendship. According to the official narrative, the U.S. was just stepping in to buttress the Japanese yen, acting as a loyal ally to a nation in need. It painted this nice picture of international camaraderie and goodwill. Just a simple favor between friends, right? But come on, we have to ask, was this really just an act of generosity? In the cutthroat world of global finance, governments rarely deploy tens of billions of dollars just to be nice. There's just no way. Wall Street immediately knew there was a hidden, deeply self-serving reason behind this massive move. Behind closed doors, the reality was far less about international friendship and way more about financial survival. What would you have done if you held the keys to the U.S. Treasury and saw a catastrophic global financial storm brewing?
The first real clue to the sheer magnitude of this secret operation came out in the craziest way. During a U.S. cabinet meeting, a Reuters photographer actually managed to snap a picture of a to-do list sitting casually on Treasury Secretary Scott Betson's desk. Written on that notepad was a solitary, unbelievable entry: buy Japanese yen 5 to 10 billion. That's $5 to $10 billion literally scribbled down like a grocery list. This incredible scoop built massive anticipation, revealing that the U.S. wasn't just offering verbal support, they were gearing up to physically hijack the currency markets.
Section 1. The yen in freefall. Okay, let's dive into this and look at why Japan was so desperate for a lifeline. For months, the Japanese yen wasn't just struggling, it was completely bleeding out on the global stage. Despite intense verbal warnings from Japanese Finance Minister Satsuki Katayama, currency speculators were relentlessly attacking the yen, pushing the nation's economy closer and closer to an absolute breaking point. Consider this staggering statistic: 164. The yen plummeted to 164 against the U.S. dollar. To put that into perspective, that marks the absolute weakest level for the Japanese currency in 4 decades. We are talking about generational lows here. For an island nation that heavily relies on importing its energy and food, a currency collapse of this magnitude is a fast track to crushing domestic inflation and total economic ruin. The alarm bells in Tokyo were absolutely deafening.
To understand how terrified policymakers really were, you just have to look at history. Joint currency interventions between the United States and Japan are incredibly, almost unbelievably rare. The last time these two financial superpowers moved jointly to boost the yen was during the 1998 Asian financial crisis. That was an era where the entire global economic system felt like it was teetering on the edge of the abyss. The fact that the U.S. felt compelled to step in now, in 2026, raises the historical stakes of this entire explainer. It proves that something much larger and much more dangerous was lurking in the shadows.
Section 2. The hidden American threat. Let's shift our focus back across the Pacific to the United States. If this was just Japan's local crisis, why did American policymakers suddenly panic? The U.S. has its own problems, right? Why risk billions to save the yen? Well, because of a highly dangerous domino effect. It starts in step 1, with the Japanese yen weakening. In step 2, to combat this, Japanese bond yields start to rise. Now, Japan is known as a massive exporter of investment capital. When their domestic yields rise, Japanese investors, like massive pension funds and insurance companies, pull their money out of foreign markets and bring it back home. And step 3, that massive capital flight causes global yields to violently spike, which lands right on America's doorstep. This is where the local Japanese crisis directly threatens the everyday American citizen. Long-dated U.S. Treasuries were already sitting around their highest levels since 2007. When Japanese yields pull capital away from the U.S., American bond yields are forced even higher. And when U.S. Treasury yields go up, literally everything gets more expensive for Americans. Mortgage rates soar, car loans become unaffordable, credit card debt becomes totally crushing. Do you think the world would look different today if the U.S. had just let Japan's currency collapse? Tell us your opinion in the comments below. Section 3. The $1 trillion twist. Prepare yourself, because this mid-explainer twist completely changes how you'll understand the United States' motivation. The U.S. wasn't trying to save Japan. The U.S. was trying to save itself from a massive financial weapon that Japan was holding, entirely by accident.
Japan currently holds an absolutely mind-numbing $1.1 trillion in U.S. Treasury bonds. They are literally one of the largest foreign creditors to the United States government, and this massive hoard of American debt was the exact reason sheer panic struck the highest levels of Washington. Here is the terrifying realization. If Japan tried to save its currency alone, they would have had to fund that intervention by dumping their foreign reserves. That means Japan would have been forced to relentlessly sell off massive chunks of that $1.1 trillion in U.S. treasuries. Flooding the market with American debt would have caused U.S. bond yields to explode upward, sending American borrowing costs skyrocketing to levels that could have triggered a deep, brutal domestic recession. Basically, Japan was about to accidentally tank the U.S. bond market just to save themselves. Eric Wallerstein from Clock Tower Group perfectly summarized this when he said, "We'd prefer them not to be selling about $50 billion of treasuries every time they intervene for little, if any, results." And so, a covert plan was hatched. According to the Financial Times, the Federal Reserve Bank of New York quietly stepped into the market. But they didn't just print dollars, they secretly sold euros to buy yen. The United States orchestrated this insanely complex, multi-currency intervention specifically to stop Japan from dumping American debt. Section 4. Curing the actual disease. So, the U.S. and Japan successfully executed the intervention, but there is a glaring problem. Pumping $50 billion into the open market to buy yen is only treating a symptom. It does absolutely nothing to cure the underlying financial disease that is killing Japan's currency.
And this brilliantly illustrates the real issue. The root of this structural nightmare is all about interest rate differentials. Capital is naturally attracted to higher returns, right? Well, right now, Japan's policy rate is sitting at a microscopic 1%. Meanwhile, the U.S. Fed funds target rate is hovering between 3.5 and 3.75%. Why on earth would any global investor keep their money in Japan to earn 1% when they can move it to the United States and earn almost quadruple that risk-free? This massive gap acts like a giant vacuum, constantly draining capital right out of Japan.
To make matters even worse, Japan is facing a deeply controversial internal flaw. Japan's Consumer Price Index, their measure of inflation, is approaching 2%. Yet, the Bank of Japan stubbornly keeps their policy rate at only half of that. Real interest rates in Japan are essentially negative. As long as government bond yields are kept artificially below where they should naturally be, Wall Street speculators will continue to eagerly exploit that weakness.
Section 5. The Global Financial Climax. This brings us to the ultimate peak of the crisis, the 15-year elephant in the room that financial media rarely talks about on the evening news. This is the very mechanism that has held the yen hostage for over a decade and a half, and it's the very thing that triggered this entire panic.
It's called the yen carry trade. Here is how this ruthless strategy works. Hedge funds and mega investors borrow Japanese yen at essentially zero interest. They immediately sell that yen to buy U.S. dollars, and then invest those dollars into high-yielding American assets. They just pocket the difference. It is literally an infinite money glitch for Wall Street, but it places relentless, crushing downward pressure on the Japanese currency. And as long as the interest rate gap exists, the carry trade will continue to destroy the yen. So what's the takeaway here? There is only one real way out of this trap. As experts across Wall Street completely agree, the yen cannot rise meaningfully unless the Federal Reserve cuts U.S. rates or the Bank of Japan finds the courage to significantly hike their own domestic rates. Market interventions, even historic, once-in-a-generation covert operations by the U.S. Treasury, are completely ephemeral. They are financial band-aids on a bullet wound. And the ultimate dramatic consequence of all this secrecy and panic? The market reaction was shockingly underwhelming. Despite the estimated $50 billion deployed to save it, the Japanese yen only rallied back to its May trading level. Zoom out, and it's still roughly flat on the year against the dollar. Sure, the intervention temporarily lowered the broader dollar index, but overall, this historic, earth-shaking maneuver barely even moved the needle. Which leaves us staring at a terrifying reality. If a $50 billion coordinated intervention by the two most powerful financial nations on Earth couldn't fix the problem, what happens to global markets if Japan refuses to hike rates next? The true global financial crisis might not have been averted, it might just be delayed. Thank you so much for joining us on this explainer. Be sure to like this explainer, subscribe to Dollar Chronicles, and hit the bell icon so you never miss out on the real stories driving global wealth. If you thought this story was incredible, wait until you see the next one. Click the next explainer on your screen now.